Futures contracts are agreements to buy or sell an asset at a predetermined price on a specific future date. Unlike an option, a futures contract is a binding legal obligation for both the buyer and the seller. These markets are massive and operate almost constantly, providing liquidity for producers and professional traders worldwide. Every contract is standardized regarding the asset type, the quantity, and when the delivery or cash settlement will occur. Stocks represent ownership, while futures are purely derivative contracts designed for hedging or price speculation. While speculators trade for profit, the original purpose of futures is for producers to hedge against price swings. Because of the high leverage involved, these instruments carry significant risk and are generally not for beginners. Thanks for watching. Understanding the risks is the first step in financial literacy. See you in the next video.